Did you know that over 30% of new businesses fail due to running out of cash? Leveling up your accounting skills is one of the best things founders can do to beat these odds. Today's video is all about accounting statements, what they are, how they work, and what they're used for. We've got lots to cover, so let's put 5 minutes on the clock. There it is, and let's just get straight into it.
Oh, what are you saying?
First up is the income statement, also known as the profit and loss. The income statement articulates profitability by accounting for all the money coming in and out of our business. It's important for founders to understand how it works, as the income statement is what we use to plan out the operating activities and what the business can really afford to take on. The basic income statement is constructed by summing up and ordering all our revenue and expenses so that we can find the net difference between them. This is how we get our net income. There are some key points we need to understand about the income statement when we are leveling up. The first is that the income statement recognises the receipt of sale, not the receipt of cash. This means a sale made in month 1 is recorded in that month's income statement, even if the payment is to be made in month 2. The second is that the income statement usually separates out the cost of goods sold, and it puts this as a separate line item under revenue in order to assess a gross profit. Cost of goods sold are the specific costs incurred by the company to generate revenue, and our gross profit is a measure of how efficient the company is at producing the core things that it sells. Both are really important for founders to keep on top of. And finally, the income statement's main limitation is that it doesn't account for the timing of cash coming in and out of the business. This is why we need to read it in conjunction with the cash flow statement, which we'll come to soon. And with that, we've wrapped up the income statement. Now it's on to the second statement we're going to talk about, which is the balance sheet. The balance sheet is the financial statement that provides a snapshot of what the company owes and owns. It does this by totaling and ordering all of the company's assets, liabilities, and owner's equity. The balance sheet is important for founders to understand how to use, as it helps us assess so many things within our business. These include, but aren't limited to, liquidity, working capital, inventory and equity ratios, just to name a few. The main limitation of the balance sheet is that it doesn't capture the movement in assets, liabilities, or equity over time. It's a static report and needs the other two statements to fill in the picture of what happens between the balance sheet days. And with that, we've summarised balance sheets. Next is to the final statement, and probably the most important, which is our statement of cash flow. The statement of cash flow provides insights into the changes in our cash position of our business. It does this by totaling and ordering all the transactions within a period under 3 broad categories. These are operating, investing, and financing activities. Ordering them in this way helps us qualify where we're bringing in and spending cash within our business. And there are some key points to understand about the cash flow statement. First is that the cash flow helps us assess the changes in our cash balance over time. This gives us insight into whether our cash balance is growing or shrinking, which in the startup world provides us clarity around cash burn. The second is that the cash flow accounts for when cash enters and leaves our business, not when the sale or expense is recognised on the income statement. This is why we use the cash flow in conjunction with the income statement. It gives us a more complete picture of when and what cash will be available within our growing business. And third is that smaller companies can actually get away with broadly categorising all transactions as either inflow or outflow of cash. Cash timing is the key, and if operations are small, then it's best to keep things as simple as possible. And with that, we're all done. Accounting statements summarised in under 5 minutes. So if you're still watching, thanks for sticking around. If you liked this video and found the format of use, then hit the like button, and feel free to share this with any other founders that may also find it of use. And finally, if you are a founder and you are looking for good advice, then reach out for a chat. It's my business to help, and I do this by first getting to know you and your business. So if you want to understand how I can help you to reach your business goals and smash them out of the park, then reach out for a chat via the link below. And until next time, my name is Aidan Keneally, professional founder coach and advisor to high growth startups, helping you, the startup founder, to be better than yesterday every day.